It's a holiday-shortened week, but from key data on the docket to certain stocks continuing to break records, there's still lots to talk about. Let's get to Jill Malandrino at the NASDAQ. Hey, Jill.
Hey, Rochelle. Electric car sales are breaking new records with momentum expected to continue through 2023 with demand surging worldwide. The International Energy Agency believes that sales of battery-powered vehicles are set to break records once again, leading to a historic transformation in the auto industry that could eventually challenge the dominance of internal combustion engines. Requesting by 2030, replacing pumps with plugs is set to avoid the use of at least 5 million barrels of oil a day. The overwhelming majority of electric car sales to date are concentrated in China, the United States, and Europe, although sales are beginning to flourish in emerging economies as well. Electric car sales more than tripled in India and Indonesia last year and more than doubled in Thailand. In emerging markets, 2- and 3-wheeled EVs outsell their 4-wheeled counterparts, offering affordable and sustainable mobility, and cars, bikes, and light vehicles are just the start. With heavier EVs, such as buses and trucks, expected to become more commonplace in the future. In fact, Amazon just announced on Monday that it has begun rolling out its custom electric delivery vans from Rivian in Europe. This will be Rivian's first commercial shipment of vans outside the United States. The IEA currently expects to see 14 million in sales by the end of 2023, representing a 35% year-on-year increase, with new purchases accelerating in the second half of this year. As a result, electric cars could account for 18% of total car sales across the full calendar year.
Now, Jill, we know that Tesla stock has been really going gangbusters of late, but what's the outlook for the industry at large?
Auto stocks have traded very well thanks to the bullish EV production figures reported by U.S. and Chinese OEMs, although investors should keep their enthusiasm in check until the margins associated with these volumes are known. For Tesla, that will come on July 19th when the company reports Q2 earnings. Here's part of the challenge as it relates to earnings. In April, the Environmental Protection Agency proposed a rule intended to significantly curtail carbon emissions. If adopted, it would require that electric vehicles make up 60% of all new vehicles sold by 2030 and 67% by 2032. It was a significant escalation from the Biden administration's previous goal of 50% electric vehicles by 2030. Now, Tesla's 4% plus better than expected 2Q deliveries in combination with global pricing trends, which appear to have roughly stabilized since declining sharply in the first quarter, paint a bit better picture of demand for Tesla vehicles than was the case at the time of first quarter earnings in April. And as such, JP Morgan modestly increased earnings estimates, even though they rate the stock underweight. Analysts are concerned about valuation. And although both technology and execution risk seem substantially less than was once feared, JP Morgan believes that expansion into higher volume segments with lower price points seems fraught with greater risk relative to demand, execution, and competitions. Now, risks to that thesis include the demand for Tesla vehicles could rise materially, gasoline prices could increase, we know OPEC's doing cuts, or government penalties and regulations on rival internal combustion engine vehicles could increase as well, which could drive adoption toward electric vehicles, benefiting Tesla. And finally, better than expected execution on operating targets. That's the risk to that underweight thesis.
All right, we do appreciate that update, Jill Malandrino, there for us at the NASDAQ. Thanks so much.